Thanks for joining me. Today we're going to talk about the 5 most common mistakes investors make when investing in Canadian venture capital markets. My name's Leishman. I'm a senior investment advisor with CG Wealth Management and a partner with LLC Private Wealth. I'm a third-generation venture capitalist, and I've got almost 30 years experience investing in Canadian venture capital markets. I've seen novice investors and those with years and years of experience make these 5 mistakes time and time again. Number 1 on my list are investors that don't understand their own risk tolerance. Now, investing is an intellectual exercise, but we as humans are emotional animals, and the two don't mix very well. Risk can be broken down into 2 basic types. One is financial risk, or your ability to withstand financial loss. This can be mitigated with proper portfolio diversification and position sizing. The bigger risk for investors active in venture capital markets is your emotional capacity to withstand price volatility. For example, if you have a favorite stock or your best venture capital idea and the share price gets cut in half, how does that make you feel? Are you crushed, or are you very excited because your best idea is now on sale for half price? Typically, most investors will focus only on the blue sky, and they'll sit and think or dream about how they're going to feel when that stock doubles, triples, or more. And when the share price doesn't happen that way, they end up feeling emotionally devastated. Having the courage of your convictions brings me to the second most common mistake investors make when investing in small or microcap stocks, which is basically not reading financial statements. Now, I'm not saying you have to be an accountant or a financial analyst to understand it, but having a basic understanding of balance sheets, income statements, and cash flow statements will go a long way to making you a much more successful investor. At LLC Private Wealth, our focus is on identifying inexpensive companies with rapidly growing earnings, and hopefully we also get some blue sky catalysts that we can pick up for free. If you're not invested in that space and you're invested more in the riskier end of the spectrum, things like exploration companies or raw startups, it's very important to understand where a company is with its cash, or lack of cash flow, or negative cash flow, so you'll know when they'll have to go back to market to raise more funds, because that will have a direct impact on the share price. Understanding a company's financial condition can go a long way to helping you deal with share price volatility. If, for example, you've bought a company trading for low single-digit earnings, and earnings are growing at greater than 50%, assuming nothing's changed with the business, if the share price is dramatically lower, say it gets cut in half, you are more likely to stick with the investment or buy more stock if you have cash available. These first 2 mistakes are pretty high level, and I suspect most of you are already aware of them. However, do you have a plan in place to deal with them? Mistake number 3 is incredibly pervasive. Basically, most investors don't know what they're looking for. They have no plan or process to identify the companies that will give them the best chance of success with the least amount of risk. Most venture capital investors may receive 20, 30, or 40 ideas throughout the year from any number of sources, be it promoters or online chats, and that is the universe from which they're making their investment decisions. At LLC Private Wealth, we screen the entire universe of stocks, and we can rank them by revenue growth, earnings margins, what have you. We have defined what we think is a best-in-class process for picking companies with a best chance of success. LLC Private Wealth clients with venture capital exposure have had a chance to review our process in detail and know exactly what to expect when they receive a company profile from us. All right, so understanding your own risk tolerance, understanding the basic relationship between financials and the company's share price, and having a plan to go out and find the companies that you think make the best investments are all key pieces. Number 4 is perhaps the simplest, and that is understanding where you are in the market cycle. Canadian venture capital markets, like all stock markets, are hugely impacted by capital inflows and outflows. And the venture markets are perhaps the most volatile. From the bottom of the market to the top of the market, the dollar value of shares traded on Canadian venture capital markets will increase by 10 times. And on the way out, as Warren Buffett said, when the tide goes out, you get a chance to see who's been swimming naked. Now, it's not as simple as just looking at a chart of the venture exchange. Over half the dollar value of all venture capital stocks traded in Canada happen on alternate exchanges. So you need to find a way to aggregate that information and make it sensible. For us, dollar-weighted value of shares traded is the best way to go. The final mistake investors make is not having enough patience. If you've found the right company and it's performing financially and the share price isn't moving, quite often investors will throw in the towel because they get bored. Like any advice, it's easy to give and receive. The hard part is having the discipline to put it into practice. At LLC Private Wealth, our clients regularly access our decades of experience as sounding boards for their speculative investments. Please book a consultation below to get an inside look at our process for investing in venture capital markets. Thanks so much for joining me.